Hey everyone, welcome back to Corporate Decoder, the place where we untangle the complex world of finance. And let me tell you, Nicolet Bankshares Inc. has just dropped a filing that has got more numbers than a tax season spreadsheet. So buckle up because we are diving deep into their latest quarterly report. And this one might just have some surprises that affect your wallet, so make sure to stick around for the juicy bits. And before we dive in, if you appreciate getting straight, unvarnished insights from these corporate documents, don't forget to hit that subscribe button and ring the notification bell. We also have a fantastic Discord community where we break down these filings even further and discuss potential investment moves. So check that link in the description below. Alright, let's kick things off by looking at Nicolet Bankshares' financial snapshot as of the 30th of September 2025, compared to the end of last year, the 31st of December 2024. Total assets sit at a whopping $9.0 billion on the 30th of September, up slightly from $8.8 billion at the end of 2024. This growth is driven mainly by their loans, which climbed to nearly $6.9 billion from $6.6 billion at year end. Now that is significant, showing the company is clearly lending more money out the lifeblood of any bank. But just how healthy are these loans? We will get to that. Moving over to their income statement for the first 9 months of 2025, Nicolet brought in a total interest income of $350.7 million. That is up from $325.5 million in the same period of 2024. That is a solid jump and indicates their lending and investment activities are indeed bringing in more money. But of course, banks don't make money for free, so their interest expense also needs a look. For the same 9 months, interest expense actually decreased to $125.1 million from $129 million in 2024. This means they are paying out less on deposits and borrowings, which is a great sign for profitability. All said, net interest income, which is the core profit driver for banks, jumped to $25.5 million for the first 9 months of 2025, a nice increase from $196.5 million in 2024. Now for the number everyone really cares about, earnings per S-Hair. For the first 9 months of 2025, Nicolet reported a diluted earnings per S-Hair of $7.14. That is up significantly from $5.84 in the same period of last year. That is a nearly 22% increase, folks. This tells us that overall the company became more profitable on a per-share basis during this period. Even when we look at the last quarter, the third quarter of 2025 earnings, per share was $2.73 compared to $2.10 in the third quarter of 2024, a solid 29% leap. But banks do more than just lend money. Their non-interest income, which includes fees from services like wealth management and card transactions, chipped in $62.4 million for the first 9 months of 2025. This is pretty stable compared to $61.4 million in 2024. Wealth management fees specifically are up to $21.4 million from $20.2 million, which is a good sign, showing their wealth management arm is growing. Now let's talk about expenses. Personnel costs are always a big ticket item for banks, and for the first 9 months of 2025, they came in at $85 million, up from $81.7 million in 2024. That is about a 4% increase, which is understandable given inflation and likely salary adjustments, and this is also directly tied to their growth. Back to the balance sheet where the real action is. Loans net came in at $6.8 billion at the 30th of September 2025, up from $6.6 billion at the end of 2024. This is the primary driver of their asset growth, but here is where it gets interesting. The allowance for credit losses on these loans also grew to $68.7 million from $66.3 million. This means they are setting aside more money in case some of these loans go bad. They are basically saying, hey, we are lending more, but we are also preparing for potential issues. And speaking of potential issues, the ratio of their allowance for credit losses to total loans remains steady at 1%. This is a key metric. It means for every dollar they lend, they have 1 cent set aside for potential losses. This ratio has stayed consistent at 1% across the board in 2024 and 2025, which shows a stable approach to risk management even as their loan book grows. Now let's look closely at non-performing loans, which are loans that are seriously behind on payments or are no longer accruing interest. At the 30th of September 2025, non-performing loans were $27.4 million, representing 0.40% of their total loans. This is actually down from 0.43% at the end of 2024. Good news, they're less risky loans on their books, and even better, their total non-performing assets, which also includes other real estate owned, remained incredibly low at 0.31% of total assets. That is a sign of good credit quality and effective loan management. In note 6 about goodwill and other intangibles and servicing rights, we see something quite noteworthy. Their mortgage servicing rights asset net stands at $18 million. A few months ago in January, they sold some of these rights for a loss which was accounted for. This indicates they are actively managing this part of their business. And now for some major news that dramatically shapes Nicolet's future. In late October of 2025, they announced a big merger with Midwest One Financial Group Inc. This is an all-stock deal where Nicolet will exchange 0.3175 of its shares for each share of Midwest One. At the time of this announcement, Midwest One was a sizable outfit with $6.2 billion in assets, $4.4 billion in loans, and $5.5 billion in deposits. This merger is massive and is expected to close in the first half of 2026 pending approvals. This is a game changer for Nicolet potentially doubling its size. We will be watching this closely. The integration of two banks is always a complex dance. Now let's talk about capital. Banks need to hold a certain amount of capital to absorb losses. Nicolet seems to be in a very strong position. Their total risk-based capital at the 30th of September 2025 was $1.069 billion, and this translates to a total capital ratio of 14.3%. This is well above the required minimums and qualifies the bank as well capitalized. This strong capital position definitely provides a buffer and allows them to pursue strategic growth like this upcoming merger. Looking at their non-interest income for the third quarter of 2025, it was $23.6 million, up from $22.3 million in the same period of 2024. This revenue outside of pure lending and deposit interest is growing nicely. Now let's circle back to the core of banking, the net interest margin. For the 9 months ended the 30th of September 2025, it was 3.72%. That is a healthy increase from 3.42% in 2024. This means the spread between what they earn on loans and pay on deposits is widening, which is great for profitability. The third quarter also saw a strong net interest margin of 3.86%, up from 3.51% in the prior year. These are really positive trends for a bank in this environment. So what does all this mean for Nicolet Bankshares Inc.? On the financial front, they are showing strong performance. Their net income is up significantly, their loan portfolio is growing, their non-performing assets are low, and their capital position is robust. They clearly have a solid operational foundation. The net interest margin expansion is particularly encouraging. However, the biggest story here is the proposed merger with Midwest One. This is a bold move aimed at significantly increasing their scale. While the financial health of Nicolet is currently strong, executing such a large merger successfully is always a challenge. Integrating two banks is a complex process, and there is always the risk of losing customers or facing unexpected costs. The filing does mention significant risks associated with this merger, including regulatory hurdles and integration challenges. They are also clearly preparing for less than ideal scenarios by increasing their allowance for credit losses. The company's strategy thus far seems to be focused on steady organic growth, which is reflected in their loan and deposit figures, and now they are making a massive leap through acquisition. Their ability to successfully integrate Midwest One will be the key determinant of their success in the coming years. If they pull it off, Nicolet could become a much more dominant regional player. If not, the risks could be substantial. Alright, that is our deep dive into Nicolet Bankshares Inc. Its latest filing, it is a mixed bag of strong current performance and a massive future bet. What are your thoughts on this merger and Nicolet's financial health? Are you optimistic or cautious? Drop your opinions in the comments below. If you found this breakdown valuable, please hit that like button and subscribe for more deep dives into corporate filings. And of course, don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we will see you in the next video.